There is a moment in investing when your contributions stop being the main character. Not stop mattering. Calm down.
Nobody is giving you permission to cancel your automatic transfer and start describing brunch as portfolio diversification.
But there is a real moment when your money starts doing more work than your paycheck. At first, investing feels humiliating. You put in $500. The market gives you $12 and a mild emotional rash. You check the app like it owes you a life-changing plot twist, and it gives you the price of lunch.
Then, years later, something changes. The same market move that used to mean $20 now means $2,000.
A boring Tuesday does more for your net worth than an entire month of being responsible. That is the crossover.
It is one of the most important moments in wealth building, because it changes what game you are playing.
Before the crossover, your savings rate is the engine.
After the crossover, your portfolio becomes the engine, and your job is to stop doing dumb things near it.
So in this video, we are going to answer 3 questions. First, when do contributions actually stop being the biggest force? Second, why does the first part feel so slow that it makes normal people want to buy a boat, even if they live nowhere near water? And third, what should you do once your portfolio starts doing the heavy lifting? The simple math is this.
Take the amount you invest in a year, and divide it by the return you are assuming. If you invest $12,000 a year, and you use a 7% return assumption, the crossover balance is about $171,000. Because 7% of $171,000 is about $12,000. That means, in a normal model, your portfolio's expected annual growth is now roughly equal to your annual contributions. If you invest $6,000 a year, that crossover is closer to $86,000. If you invest $24,000 a year, it is closer to $343,000. If you invest $30,000 a year, it is closer to $429,000. This is why the first $100,000 is the hardest is not magic. It is math wearing a motivational hoodie.
The number is not sacred. The mechanism is. Early on, your contributions are doing almost everything. Imagine you have $5,000 invested. A 7% year makes $350.
That is useful, but it is not exactly called a family office money. It is more like your portfolio found a coupon. If you contribute $1,000 a month, the $12,000 you add matters far more than the $350 of growth.
At this stage, the market is not your wealth engine. You are.
Your income, your savings rate, your ability to not turn every raise into a lifestyle subscription.
That is the engine. This is also why the beginning feels broken.
People hear compound interest and imagine money reproducing like it has no supervision.
But early compounding is quiet. Painfully quiet. The first dollars are not dramatic because the base is small. 10% on $1,000 is $100.
10% on $1 million is $100,000.
Same percentage. Different emotional weather. This is why rich people can sound annoying when they say things like, "I just let my money work for me." Of course you do. You gave the money a fully staffed office and dental benefits. For everyone else, the early phase is not passive income. It is active patience. You are building the machine before the machine can build anything back. That is the part nobody wants to put on the thumbnail. In the first phase, the most important question is not, what is the perfect investment? The most important question is, how much can I consistently put in without detonating my actual life? Because when your balance is small, a slightly better return does not beat a much better savings habit. If you have $10,000 invested, 1 extra % of return is $100 a year. If you increase your monthly contribution by $200, that is $2,400 a year. This is the part where the spreadsheet quietly insults your stock-picking confidence. Before the crossover, behavior beats brilliance. Automation beats motivation. Increasing income beats obsessing over tiny portfolio tweaks. Avoiding high fees beats pretending you have a secret relationship with the next market cycle.
And most importantly, staying invested beats the annual tradition of selling low and calling it risk management.
Then the balance grows.
At $50,000, a 7% year is $3,500. At $100,000, it is $7,000.
At $200,000, it is $14,000.
At $500,000, it is $35,000.
Now the portfolio is no longer a sleepy side character.
It is beginning to move the plot.
This is where people first feel the machine turn on. You still contribute. You still work.
You still have to make decisions like an adult, unfortunately. But the portfolio starts throwing off changes that are larger than your monthly deposits.
And this is psychologically weird.
When your account drops 2% early on, you lose $200 and become a philosopher.
When your account drops 2% later, you lose $10,000 and suddenly every financial news anchor looks like they personally betrayed you.
The same compounding that helps you on the way up also makes volatility feel louder.
This is the second trap.
Before the crossover, people quit because the progress feels too slow. After the crossover, people make mistakes because the swings feel too large. That is why the goal is not just to reach the crossover.
It is to become the kind of person who can survive it.
Because once the portfolio starts doing more work, your job changes.
Your job is no longer only add more money.
Your job becomes protect the process.
That means keeping your costs low.
Fees sound tiny when they are written as percentages.
1% does not feel like a lot.
It feels like the financial equivalent of a rounding error.
But 1% on $500,000 is $5,000 a year.
1% on $1 million is $10,000 a year.
That is a small number until it starts billing you like a luxury apartment. After the crossover, little leaks become expensive. Taxes matter more. Asset allocation matters more. Panic matters more. Concentrated bets matter more.
And lifestyle creep becomes more dangerous because your account finally looks impressive enough for your brain to start auditioning for a worse personality. This is why the phrase contributions stop mattering is dangerous if you take it literally.
Contributions still matter because they control the floor. They give you new capital.
They help during down markets.
They keep the habit alive.
They reduce the pressure to chase returns. And if you are investing through tax-advantaged accounts, the contribution itself may carry tax benefits, employer matches, or other plan advantages. So no, you do not hit a number and retire from discipline.
You just stop relying on discipline as the only engine.
Think of it like pushing a stalled car. At first, you are doing all the work. It is awkward, sweaty, and strangers are silently judging your life choices. Then the car starts rolling. You still guide it. You still need brakes. You still need to avoid driving into a ditch because someone on the internet said ditches are undervalued. But the physics have changed.
This is the investing crossover. The machine has momentum. Now, there are 3 practical ways to use this idea.
First, know your own crossover number.
Do not borrow someone else's milestone.
If you invest $6,000 a year, your crossover number is very different from someone investing $30,000 a year.
The internet loves universal milestones because they are easy to sell.
But your actual milestone depends on your savings rate, time horizon, risk level, account type, taxes, fees, and return assumptions. So calculate a range.
Use 5%, 7%, and 9% assumptions.
Not because any of them are guaranteed, but because ranges keep you from treating a spreadsheet like a prophecy.
Second, respect the boring phase. The boring phase is where most of the future is built. Nobody wants to hear this because the boring phase has terrible branding. It is not dramatic. It does not make you feel financially awakened.
It mostly looks like automatic transfers, normal index funds, and not buying the emotionally suspicious car.
But boring is where the machine is assembled.
If your account is small, do not waste your life trying to optimize tiny differences.
Build income. Build consistency. Build the habit.
Avoid debt that eats your cash flow.
Get the match if you have one. Use tax-advantaged space when it fits your situation. Make the default behaviors so simple that your worst mood still cannot sabotage it. Third, once the machine is working, stop treating it like a casino with better fonts. The larger the portfolio, the more expensive your mistakes become. A bad allocation, a high-fee product, a panic sale, a concentrated bet, a tax mistake, a lifestyle upgrade you cannot unwind. These are not small errors anymore. This is why later-stage investing is less about finding magic and more about reducing self-inflicted damage. You do not need to become a genius. You need to stop interrupting compounding while it is doing its job. That is the unglamorous truth. The first phase rewards effort. The second phase rewards patience. The third phase rewards restraint. And restraint is hard because it does not feel like action. But in investing, not touching the machine is sometimes the most productive thing you do all year. So here is the clean takeaway. If you are early, your contributions matter enormously. Do not be discouraged because the account looks small. Small accounts are supposed to look small. That is not a personal failure. That is arithmetic being rude. If you are near the crossover, understand that the machine is starting to help. Your savings still matter, but now consistency and time are beginning to team up. And if you are past the crossover, the challenge changes. You are not just saving money anymore. You are managing a system that can now move faster than your paycheck. That is exciting. It is also where people start making expensive mistakes because the numbers finally look real. So yes, there is a moment when your contributions stop being the main character. But they do not disappear. They become the supporting cast that keeps the whole story from becoming a cautionary tale. The goal is not to stop contributing. The goal is to build a portfolio so strong that one day, your contributions are no longer carrying the entire weight of your future. That is when investing starts to feel different. Not because you found a secret. Because the math finally got enough mass to be visible.